Hello and welcome to Mint. I am Nasrin Sultana and this is All Things Markets. As we are just few days ahead of the union budget, there's a lot of expectations riding on the event. There is an expectations and optimism that the government is probably going to announce some boosters for the stock markets. How risky is this bet and what are the key expectations of the stock markets from the budget? To discuss that and more, I am joined by Balasubramanian. He is the CEO and MD of Aditya Birla Mutual Fund. So Bala, welcome to the show. Straight away dive into the question. What are the key things that the stock markets is expecting from the budget?
Of course, as it happens every year, this year two expectations are built up in the market and it reflects on the way the market is behaving in the sense that last few weeks some bit of buoyancy has come in the market. Yes. This comes purely on the basis of expectations. What are those expectations? One, of course, the expectation is what steps the government is taking actually to revive the economic growth. So we have seen in the last 20 years the economic growth has been slow and now touched a low of as low about 4.5%. So therefore, naturally, we look for some steps that is being taken by the government to get back on growth path. And second, of course, is about personal taxations. I think what is leading to the current slowdown is about investment not happening in a right proportion to revive the economic growth. And second is the consumption, the theme which has been on the driver of the Indian market has not been up to the mark, which reflects on the way two-wheeler sales are happening, four-wheeler sales are happening, there is a slowdown. Therefore, what the government is going to do to kickstart the consumption theme in the form of a tax cut. Right. And third, from the capital market point of view, there are few provisions that are made in terms of long-term capital gain tax. It was introduced about the last budget. And since the time they introduced the long-term capital gain tax, there is absolutely no tax has been collected by the government, which again makes them realize is that provision is needed or not needed. And fourth, of course, is about the sectors which is of course struggling the most at this point of time is the real estate sectors, which again has got an impact on the whole economic growth in the allied sectors. What steps are being proposed actually in the budget towards reviving the interest in the real estate sectors so that the overall momentum in the economy can come back. Therefore, the expectations on budget is quite clear. Is around taxation, is around steps that is being taken for reviving the economic growth. And finally, I think what kind of fiscal number, I think they'll be okay to live with that in order to actually push the economic growth.
So I'll come to all the steps that you mentioned one by one. But first, let me ask you: do you think this time there's a lot of expectations kind of build for the budget? Because as you mentioned, the economic slowdown, and yet the stock markets have rallied to multiple record high in the last few months. Do you think the expectations are really built up? And if the government doesn't actually meet the expectations, it's going to be really disappointing.
Of course, it happens every year. What is the source of these whole expectations? The source of expectation is from here as we move forward, would you see further degrowth or would you expect a growth to come back? And the answer to that is, I think, is most of them are expecting actually the growth to come back, given the fact that the government is taking a lot of steps in addressing some of those pain points by engaging with the conversation of the market players and therefore trying to find the solutions. I think this continues, and then what they have done in the last 2-3 months in terms of taking input from everyone and then going to convert those hearing from the market into an action in the form of a proposal in the budget. Naturally, I think we can make it as a win-win situations. Therefore, the hope is that I think the government would implement some of the listening that they have done from the market players, and therefore it is obvious to accept the momentum in the market as a reflection of the confidence that the people have got on the government.
Right. You spoke about the first expectation is about the stimulus package that the entire capital markets community and as well the whole country is waiting for.
Correct.
So what exactly the fiscal stimulus you're looking for?
See, fiscal stimulus is the, of course, government does not have much scope for giving a fiscal stimulus. If you go by the simple math, we already had 3.3% on fiscal, and if we combine the state deficit as well as the public sector enterprise deficits, I think we must be one of the highest in the last maybe a decade or so. I think we are much higher than what we saw in 2008. The aggregate fiscal going up to as high as about 8.2 or 8.3. Right. Having said that, I think there is a slowdown and there is high liquidity and growth is not coming back in a hurry. At the same time, tax collections, especially on GST, is not up to the mark. Right. In this kind of scenario, then what do you do? I think naturally you need to give some kind of stimulus to the economy in the form of some tax cut, even if it means it's going to have an impact on the fiscal deficit on the negative side. But that's the call I think one has to take. I think it's more of a trade-off one has to take between growth versus fiscal. And today's scenario where there is a lot of money, there is absolutely no demand for money, and therefore there is not going to have any kind of harm in the economy per se if the government of India comes to borrow for more and by denying money for the private sector capital, as long as that is not put at risk, naturally I think one government can take a bet on
But in
fiscal responsibility.
September, last year, government had introduced or rather announced the cut in the corporate tax, and that is probably going to have a heavy impact on the government's receipt on the kind of taxation they had.
Correct.
So this itself is taking a lot of burden on the government's fiscal.
Correct.
You still think the government has enough room to kind of have more stimulus package for the corporates?
So I think if you look at the room for cutting further rate is not there. But again, if you have to look at this in conjunction with the growth that we need to get it back. If you have to get the growth back, one need to of course give somewhat of compensation for that in the form of rate cut, which is what I think I would not rate cut. Sorry, it's about tax cut. I would assume that's what could potentially the government may look at doing it, and given the fact that India can easily grow at about 6.5%. At the same time, tax collection is a function of the economic growth. If the economic growth comes back, then tax collection could come back. Therefore, one has to take a bet on that. And having said that, even the GST, the last few years, they have been making course correction. There is a high probability that what they have discovered in the last 6 months in terms of GST tax collection, wherein they have found out that a lot of refunds are being claimed, which could be some of it could be genuine, some of it could be not genuine. Therefore, how to fix those gaps? I think they're able to fix those gaps using technological upgradation on one side. At the same time, they look at on a forward-looking basis on tax cuts so that they can boost the income, so that increase in economic growth back to normal could potentially impact the growth.
So, shifting focus to actual market, participation, DI money in the last 3 months actually have slowed down. In fact, it's a negative November, December, and also this month so far. Whereas FIs have been pumping money in India. What is actually kind of not giving that kind of confidence to DIs?
I think DI is a function of the last 5-6 years of growth, and last year there was some bit of slowdown in the mutual fund flows compared to the inflow that we saw in 2018, as well as 2017 was a peak year, then 2018 was lower, and 2019 was lower than the previous 3 years. I think that's a function of allocation that comes in, function of sentiment, and function of the market return.
But this is despite the SIP money, which is very much intact. It's above 8,000 crore for the entire 2019, if I'm talking about monthly SIP flows. But despite that money coming from SIP, the retail investors, the fund flow or the tandem of the flow has slowed down. So what is the reason?
I think the reason was, again, as I mentioned about, is the function of your experience. I think the function of growth slowing down. And if there is economic growth slow down, then naturally there is a bearish sentiment sets in. And there is divergence that the performance that we saw, as you rightly mentioned earlier, only 10 stocks have performed in the last 2.5 years, whereas the rest of the market has not performed. And whereas most of the money that has come in the rest of the market, not in the only 10 stocks. So therefore, it did have some kind of not so good experience for the investors. And we have seen it in the past. We have seen it whether it's 2008 or 2013 or even before that 2002 when there was a recession we have seen. We have seen these cycles come and go. But I would assume, I think for the investors to come back, is not that difficult as long as the overall sentiment improves. Probably what is being expected for such a larger participation to come back as we in the past is actually budget could act as one of the trigger on the basis of what we spoke earlier about various provisions that can be changed.
But one last question I want to throw in. One scenario, where do you expect the market to head if government actually meets all the expectations that the street is hoping for?
Right.
Another scenario where the government does not meet these expectations, throw some shocker like it did in the July budget, where the market is headed in both the scenarios.
I think I would say that market would probably head to a little bit of positive side. One, given the fact that the liquidity in the system is quite abundant. Emerging market inflows have been rising, and globally, even US, after saying last 10 years of good bull market, now there is a huge debate is going on. For the next 10 years, probably we'll see money moving to the emerging market. If that starts happening in the form of ETF flows as well as larger participant coming from the global investors and invest in India, led by the liquidity, led by the outlook that is changing for emerging market, we will see the India also getting their due share. Having said that, India also I think simultaneously address some of the pain points that has been associated with the Indian economy, which is leading to a slowdown, and is being addressed one by one. Probably we'll see that also will change the whole sentiment. Lastly, of course, is about the whole the consumption led by divided by two parts: one urban consumption and rural consumption. Rural consumption could come back even if the government doesn't do anything on the base of the good monsoon, and so that the good crops and increase the rural income. Therefore, that could come back. Then what they need to address is actually the urban consumption in the form of tax cut. So I think all in all basis, if you look at, I think overall broad market, I would see being in an uptick.
So you're basically saying if the government kind of announces some negative, expectations, then probably the market would take the budget as one of the event and move ahead, and probably depend on the foreign liquidity and the other consumption that you mentioned.
I think we'll come back to the some bit of expectation on foreign flows coming in, liquidity, as well what are the alternate that you have, and therefore you stay invested. And even if alternate, if you look at where all I can go and make an investment alternate is on fixed income, his rates are low, real estate is
But
still.
gold is a competing asset class. Gold is kind of showing good returns, especially with the virus that is seen in China. So people are rushing to a safe haven, which is gold. So you don't see that as an impact having on India in terms of asset.
No, we could be, but I think the people who actually predominantly invest in the capital market and the more and more awareness that got created in the mutual funds, they prefer to actually come into the mutual fund schemes on the base of tax adjusted return basis. Definitely the mutual fund, both equity asset class as well as fixed income asset class, give a better experience with a better liquidity and also the better comfort. I'm not saying gold is bad. Gold also an asset class. Even we as a fund house are turning bullish on gold for the next 1.5 2 years. But thing is, ultimately, if you look at the longer term return, I think equity gives the best return. The next is fixed income, and then third is gold.
On that note, thanks a lot for talking to us. A lot of insights, and we hope the stock markets take the budget announcements in its stride. Thanks a lot.
Yeah, thank you.
So, a lot of hopes and optimism that the union budget will have fiscal stimulus and boosters for the slowdown in the economy, and probably it will uplift the sagging economy. We'll keep an eye on that, and we'll see what are the big announcements by the finance minister Nirmala Sitharaman on 1st of Feb. We'll come back with more details. That's all for now. Thanks for watching. For more details and updates, stay tuned.